Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. This is going to be a very different video from what most of you are used to. You guys know that we are a very crypto-eccentric channel. I mean, the name of the channel is All in Crypto. But really, for the past 6 months now, we've been doing a lot of looking at the kind of macro landscape that we find ourselves in. We've been looking at the Fed, we've been looking at the stock market, we've been looking at the bond market. We've really been paying a lot of attention to macroeconomics, as it is really what is driving not just the crypto space, but markets across the board. And March 2020 for me is still an exceptionally pivotal moment for not only monetary policy, but the financial system as we know it. And I really wanted to do a video on the Nasdaq because I see serious risk with the Nasdaq, and the risk, unfortunately, is to the downside. And when people look at this, you know, they kind of, the instant thing that I often get is they go, okay, well, you know, this has happened before, and we've already sold off significantly. I mean, the Nasdaq is already down from the all-time highs back in November when they started talking about interest rate hikes. It's already down 34%. But in this video, I'm going to be telling you why I think the Nasdaq is probably going to go under 9,000 and potentially head down towards your 7,000 to 6,000 range, because I'm seeing a lot of similarities, certainly technically, looking at the Nasdaq today and looking at it in the dot-com boom. Certainly when you take into account that the Nasdaq today is still almost as overvalued as it was during the dot-com boom, which leads me to believe that there is still a lot of downside, a lot of real value to be taken account for, and a huge repricing of not just the Nasdaq, the crypto space, the equity market, and everything to do with it. Because essentially now, really since the 2008 crash, the Nasdaq has just been on a constant bull run, and the Fed have continuously stepped in and had your back. You know, there's been this kind of mantra of TINA thrown around where you don't have any real other options. You don't want to hold cash, certainly when you have the likes of the S&P and the Nasdaq that just continuously outperform a cash position. But I think those tables are flipped, and I still think that March 2020 is unprecedented. And one thing that people continue to throw at me is, oh, well, last time this happened. When was the last time, by the way, you saw the bond market do this? In its 40-year history, okay, barring the start of the bond market, we've essentially been since 1986 in a continuous, this is the yields, by the way, guys. So the bond market has been in a continuous bull market. That has now changed, and you're now seeing yields get out of control, and this is all coming on the backdrop or after March 2020. And there's all sorts of reasons being thrown around by why this is happening, but the reality is, guys, that we live in a failing fiat system, and we can talk about Bitcoin a little bit later on in this video. And, you know, things are breaking, and the Fed are going to break something. We've been risk off crypto now for, we weren't the earliest, but nearly 6 months we've been telling people to be cautious, given everything that's been taking place. And I don't think it ends here. And yes, when we look at crypto, you could see a bounce here. It's not out of the realms of possibility. Certainly you're around your 200 weekly moving average. You also do have support here. You will have people that will be looking to take profits. And of course, we've got the Fed meeting coming out later. But when I look at the Nasdaq, it worries me on a number of levels. And one thing that really worries me the most is looking at how it's acted since the 2008 crash and looking at how it acted on the run up to the dot-com boom. You know, you can see you had the crash of 19 in the 90s. And then you can see what it essentially did. It went on a bull run for a long period of time, got very overextended, very overvalued. You get that FOMO, you get that kind of mania. And then, of course, it crashed horrifically. I think given the fact that this was the lead up to the dot-com boom, it looks exceptionally similar to where we currently are today, guys. Exceptionally similar. Which leads me to believe that you're going to have a Nasdaq that potentially, and I'm not actually calling for this, but potentially you could do a round trip from March 2020. So we've seen all this money pumped into markets. The problem with going up so fast is that it really doesn't provide much support on the down leg, just like we saw in the dot-com boom. In fact, these are almost identical. What I'm going to do is actually pull up another chart with the Nasdaq arm. So we'll pull up another chart of the Nasdaq. We'll take any draws off that we've got. This is Ethereum. Where are we? Come on, Nasdaq. There he is. So if we look at this, and we look at what happened here, you know, you can see just how similar these are. We've got an EMA there. I'll tell you what we could do, actually. We'll just use the EMA for argument's sake. You know, you can see that this is very, very similar structure. And this fills me with a lot of cause for concern. Certainly given the fact that when you look at stocks as an individual company, I think it's going to be a very tough time from them. I think any company that has corporate debt, they're getting squeezed on that level. Their products are going to have to become more expensive to account for inflation in the commodity market. And on top of that, you're going to have a significantly less consumer demand for the products that many of these companies produce broadly. And the reason for that is I speak to everyday people and they are getting pinched from multiple pressure points, whether that be fuel, whether that be their mortgage payments, you know, and in an economy that is looking, if the Fed, the only reason that this wouldn't play out again is if the Fed step in and do something, which isn't out of the cards, by the way, ladies and gentlemen. The Fed absolutely could step in, and that's when we pivot to being bullish again. We'll switch to the one chart, but we will see that. You know, one thing that we've been looking at with our Patreon members is the euro dollars future. We'll take off the EMA, and we will change this to a line chart. The euro dollars future is something we've been paying close attention to, really in regards to Bitcoin, because you can see when the euro dollars future started to go down, which is essentially a way of people speculating on interest rate hikes, this is when Bitcoin started to tumble, which is why we've become armchair macroeconomists, to say the least. I am by no means stretch or no means shape or form, by any stretch of the imagination, the best economist out there, the best macro guy out there. But I'm paying a lot of attention to this right now because it looks like we are heading for lower prices. The Nasdaq could get some kind of a bid up here, certainly depending on what the FOMC or the Fed or really JP comes out and says. But ultimately, for me, these rallies are for shorting if you're a trader or getting out if you're a hodler. And that is not financial advice. That's just my own personal stance. We've been out. We've been largely in cash. We do keep a small crypto position just simply to hedge me being wrong. But we are majority cash and majority risk off, of my position really dictate or represents that. And the big thing for me is when I look at consumers, if the Fed don't step in, and they will have to step in at some point and stimulate, because we'll end up, you know, it would be, I think, a real significant, forget recession, you're talking about depression if they don't step in and advert from the course that they're on. The thing you've got to watch with the Fed fund rate as well is, and we've done this in deep analysis on this channel, is every time, the last time they got to 2.5%, they broke the repo market back in 2019. That's when we had the bond yield curve inversion. Shortly after that, March 2020 happened, 6 months after. We've now had another inversion. We're likely going to get another inversion again, or I think even a couple of days ago, we had another touch below it. That's probably going to happen again. And this is all warning us that something major is on the table. And you guys will know, given the correlation, if the correlation between the crypto market and the equity market persists, you guys know what the score is here for crypto. If this goes down, the crypto market is going with it. We're already seeing real shaky ground on the crypto space. You guys know that we did say we were going to get down to these kind of price levels. Not only do you have your 200 weekly moving average, we've also got the long-term regression bands that we've been looking at continuously. But for me, you know, this was really a video focusing on the Nasdaq and really pointing out the similarities that we're seeing today and what took place in the 2000s dot-com boom, or bust, I should really say, boom and bust. And you could get some sort of rally here. Typically, you're going to get a reaction around about the 200 weekly moving average. And people look for rallies. The harshest rallies occur in a downtrending market. And this gets everybody FOMOing in until they get killed off. If we look at the 2008 financial crisis, the Fed stepped in very, very quickly to actually bring things up. And you can see the rebound that we had after that. We're looking at that as a potential scenario, but I think the Nasdaq could get significantly lower than where it currently is in order for that to happen. Because their main mandate right now is killing off inflation. The CPI print that we had on Friday told me everything I needed to know and told me, absolutely validated the risk-off approach that I've maintained. And you can see 200 weekly moving average, you get some sort of a bounce, consolidation before you get a further capitulation. That's what we're looking at today. And if you go and look at these charts for yourself, guys, go and look at the run-up that we've had since 2008 all the way to today, and look at just how similar it is from the 1990s all the way up to the dot-com crash, where you were very overvalued. Today, you're still as overvalued in terms of looking at something as an individual company as you were back then, even though we've sold off 33%. Moving on to the monthly chart. Where did you bounce on this rally? And where have you always found support typically? The monthly moving average. 200 monthly moving average, which is currently sat around about 5,312. I'm not calling for that, but I'm saying it is a possibility. And again, if the Fed pivot, we change our stance. Even more importantly than price right now, we're looking at macro and we're looking at the conditions that are presenting themselves. But this could potentially be a real nasty time period for the likes of the Nasdaq and the stock market, and see a real further capitulation event, similarly to what happened in the dot-com boom and bust. I don't think that's off the cards, and I think to rule that out, given all the information that we've received over the past 6 months with what's going on a macroeconomic sense, I mean, let's just overlay the, you can see, whenever the Fed up interest rates is bad for markets. And this euro dollar's future, this is acting just crazily. There's so many unprecedented things taking place right now. Last but not least, the bond market. I mean, it's just like, this is, and we've had great people on the show, like Francis Hunt, the market sniper, who have spoken from March 2020 onwards about this being a debt-destroying event. And this is what it looks like. When have we seen this kind of action in the bond market? And people still think the Fed is going to step in and save them. They will, but later on. How on earth can they pivot from this point where they're currently at? Because they already have huge egg on their face, huge amounts of inflation that is absolutely killing off consumer. It's just not a good situation. And when you think about a company internally, and you think about the fact that your average everyday people, who are near enough, most people out there, by the way, are on the breadline. They've been pushed into poverty as a result of everything going on. That echoes through to markets. And there is a huge argument there that, okay, well, companies, money doesn't just evaporate. Right now, we see very large cash positions across the board. We don't really see that bid for the bond market. There's lots of talk that that's going to happen because of what's going on in Japan, and we're going to see an exodus of money coming into the US stock market to kind of, or not stock market, bond market, to stabilize things. But when I look at this is so similar. It really is absolutely similar. And what I'm actually going to do is I'm going to click playback. I'll tell you what I'm going to do. I'm going to pull up another chart again. Apologies for the slightly longer video than I'm sure some of you guys are used to. But we're going to go all the way back here. Not that far back. Apologies. And what I'm going to do, tell me that doesn't look similar. Now, just because it's happened once and I'm saying it looks similar doesn't mean it's going to happen again. But I certainly think there is a macro storm that we've covered on this channel many times that perhaps suggests that this might be the likelihood. Do we see this play out? Remember, you get these really harsh rallies. We're likely going to get a rally somewhere around here, guys. But it gets killed off eventually if the Fed don't pivot with what they're doing. And if they do pivot and they go to stimulating the economy again, and they go to really reimbursing everything and, lowering interest rates, I mean, that's not a great situation either. It may be for assets, certainly risk on assets, but for the general consumer, it's going to leave them in probably a worse situation than what we're currently seeing, because it's not going to get rid of it. I mean, inflation is it's kind of like fighting a losing battle at this point, but the Fed are trying their, I don't want to say best to combat it, but certainly, trying with what they're doing. Do we see this just play out again? It's a possibility. I'm not saying 100% it's going to, but it could, and it's something you guys should all prepare yourselves for. This is not scaremongering or anything of the sorts, because ultimately I don't want this to happen. But I'm saying, prepare, be prepared. You're not going to go on and make new all-time highs anytime soon. I think we can all agree on that. And to be a little bit more prepared for more downside in the equity market as a result of everything going on, there's every reason, by the way, for the dollar to continue higher. If you understand what upping interest rates in a debt-based system does, it drives demand for dollars, because you need more dollars to pay off the debt that was already, how money gets created is through debt. And inherently, it has to be an inflationary system, because if I just give you $1, you've got to pay me back $1.01. Well, where'd you get that extra cents from? It has to be inflationary. Well, you now have to pay me back $1.05. So you need more dollars. This is why the repo market saw real issues back in 2018. Anyway, that is it for the video. Just sharing some thoughts. Let me know in the comments section what your opinions of this are. Is this just scaremongering? Am I way off? Potentially I am. Do I think the Fed is probably going to step in before we get to and we get to relive a 2001, 2002 nightmare? Probably. But it really is all about the Fed and what they're going to do, because they're absolutely killing off markets right now, guys. There's no clear signs that this is going to stop. That being said, if I was looking to exit a position or reduce risk, I will always do that into strength. I will never, ever, maybe under extreme circumstances, but it's very rare that I will sell hard on the nose of a down leg. And there is also the potential that, look, you maybe close this gap before we go and get that lower. We'll see what the Fed have to say this evening. Certainly evening for me. I think it's about 2:30 Washington time. It will be around about 7:30 for me, I believe. But I'll keep you all posted, of course. Let me know your thoughts on this. It was a bit of a different video. We don't usually cover the Nasdaq, but certainly a lot more pain is on the cards, in my opinion. I definitely see 9K getting run for the Nasdaq, or certainly 950. And there is always the potential that we start to get down to 7,000, 6,000, potentially, and do a round tripper, just like we've seen, just like we saw in the dot-com boom. And, the hallmarks are there. Does it mean it has to play out? No, it doesn't. We're in an ever-changing landscape, and you have to be an active investor if you want to be a good one. I think the days are almost gone of just buying the dip and, the Fed having your back. I think there's greater forces at work here. And I think certainly when you're given the overvaluation of the tech market, really more than anything, and which makes up a large part of the Nasdaq, it really is a recipe for disaster. So I can see significantly more pain for the Nasdaq over the coming months. Rallies will happen, but ultimately, for me, if I was a betting man, and certainly I'm positioned accordingly, I would say that there's a lot more downside risk than there is upside. All I've got for you in this video, guys. If you've enjoyed the content, a like is always appreciated, so is a comment. And I'll catch you all in the next YouTube video.